Hi, I'm John Precipice, Editorial Director of Investing Daily. Welcome to my video presentation for Monday, August 21st. To view our full range of trading services and publications, visit our website at investingdaily.com. Also visit the website of our subsidiary, streetauthority.com. After a robust stock market rally from March through July, the mood on Wall Street has darkened in August, with stocks posting a decline. Are we witnessing a healthy consolidation phase, or do we stand on the cusp of a full-blown correction? Is the August slump a brief pause, or the harbinger of a steep plunge? Let's look at the data for clues. Leading the equity swoon have been mega-cap technology stocks. Most of the brand-name tech stars already have fallen more than 10%, a magnitude that signals an official correction. The question now is whether the downward momentum will spread wider and last longer. Reasons for optimism remain: bullishness over economic resilience, particularly the jobs market, and artificial intelligence hasn't completely dissipated. But in the meantime, the rally has lost momentum. Take a look at the following chart. U.S. and international stocks finished last week in negative territory. The Dow Jones Industrial Average fell 2.2%, the S&P 500 fell 2.1%, the tech-heavy Nasdaq fell 2.6%, and the EAFE fell 2.8%. The benchmark 10-year Treasury yield rose 0.1% to hover at 4.25%. Crude oil prices, despite production cuts by OPEC+, fell 3.1% for the week. Another reminder that the oil cartel only has so much power and market forces have the final say. The narrative on Wall Street has shifted from soft landing to recession, and oil traders now fear demand destruction. The minutes of the Federal Reserve's July meeting, released last Wednesday, were surprisingly hawkish in tone and suggested that further rate hikes are ahead. Also eroding optimism was the latest economic report from China, which showed worse than expected performance across the board. The country's second quarter gross domestic product GDP growth widely missed expectations. China's economy expanded by just 0.8% from April through June compared to the first 3 months of the year. China's industrial production rose by 3.7% in July from a year ago versus 4.4% expected, largely due to weak manufacturing activity and mining output. What spooked global investors even more was the bankruptcy filing of China Evergrande Group. The debt-riddled property developer has posted massive losses. Other property developers in China are struggling as well, raising fears of a real estate implosion in China that could trigger financial contagion. Several major Western banks and asset managers, such as BlackRock, have exposure to China's faltering real estate sector. I think the U.S. economy will decelerate in the face of higher interest rates, but I don't see the case for a sharp downturn. It's still possible to avoid a recession. Consumers continue to spend. Corporate earnings are forecast to return to the black in Q3 and Q4. The employment situation is strong but not overheated, and inflation has been markedly cooling. It's especially heartening that U.S. GDP continues to surprise on the upside. GDP increased at a 2.4% annualized rate for the April through June period, surpassing the 2% consensus projection. GDP rose at a 2% pace in the first quarter. The Fed currently forecasts third quarter gross domestic product growth of 4.1%, which is an astounding number. We got some bad news last week, but not enough to undermine the equity rally in a lasting way. Now let's take a look at the week ahead. Here are the major economic reports and events on deck in the coming days that have the power to move markets. Existing home sales Tuesday, S&P flash U.S. services and manufacturing PMIs, new home sales Wednesday, Fed officials interviews from Jackson Hole Summit, initial jobless claims, durable goods orders Thursday, Fed Chair Jerome Powell gives opening speech at Jackson Hole, and University of Michigan consumer sentiment Friday. I don't foresee a correction, but as I've just made clear, uncertainty will continue until the Fed's monetary policy stabilizes. If you're looking for ways to generate steady income, regardless of the market's ups and downs, consider my colleague Robert Rapier. Robert Rapier is Chief Investment Strategist of our premium advisory, Utility Forecaster. No one understands dividend-paying stocks better than Robert. After painstaking research, Robert found a rare type of investment that has raised its payouts by double digits every year for the past 16 years. If you're tired of anemic payouts, Robert has the remedy. For details, click the URL at the bottom of the article that accompanies this video on the Investing Daily website. Well, that's it for now. And if you have any comments or questions, or if you have any story ideas about topics you'd like to see us cover, please don't hesitate to send an email to me at mailbag@investingdaily.com.